Have you ever noticed something strange? Gold often moves before the news explains why. It rallies before the official inflation data is released. It climbs before central banks announce rate cuts. It makes its big moves before the headlines ever go mainstream. So, what does gold know that most investors don't? In this video, I'm going to break down exactly what actually moves the price of gold, and more importantly, why it so often seems to be one step ahead of everyone else. Most people think gold rises because of inflation. It's a common belief, and it's partially true, but that explanation is totally incomplete. If inflation alone drove the price of gold, then gold would rise every single time inflation goes up. But that's not what we see in the real world. Sometimes inflation climbs higher, and the price of gold actually falls. So what's really happening behind the scenes? The answer is that gold doesn't just react to the inflation number itself. It reacts to something much deeper, a more powerful force in the financial markets. The real driver of gold is a concept called real interest rates. It sounds complicated, but it's actually simple. Real rates are just the interest rate you can get on your money, minus the rate of inflation. For example, if interest rates are at 5% and inflation is running at 3%, your real interest rate is 2%. Now, here's why this is the crucial metric for gold. When real rates are high and positive, assets like cash and bonds give you a real return. You're actually growing your purchasing power. Gold, on the other hand, pays no yield. It just sits there. So, in that environment, investors will naturally prefer the interest-bearing assets. But, when real rates start to fall, especially when they head towards zero or even turn negative, cash and bonds start losing purchasing power to inflation. And that's the exact moment when gold becomes incredibly attractive as a store of value. You see, gold competes with real yields, not with inflation alone. Now let's add the second critical layer to this puzzle, the US dollar connection. Gold is priced globally in US dollars. This creates an inverse relationship. When the dollar strengthens against other currencies, it makes gold more expensive for buyers around the world. As a result, global demand tends to drop, and the price of gold often falls. Conversely, when the dollar weakens, gold becomes cheaper for international investors. This boosts global demand, and the price of gold often rises. So, gold isn't just reacting to a single headline. It's constantly balancing a dynamic combination of real interest rates, the strength of the dollar, and overall liquidity conditions in the market. So, here's the key insight that ties it all together. Why gold moves before the news. It's because markets are forward-looking. They are massive discounting machines that constantly try to price in the future. Professional investors and traders don't wait for the Federal Reserve to actually announce an interest rate cut. They anticipate it. They position themselves based on what they expect to happen. If the big players in the market believe that real rates are going to fall 3 months from now, they won't wait. They'll start buying gold today. That's precisely why you'll often see gold making a significant move before a big CPI inflation report, before a Fed meeting, or before an official policy shift is announced. Gold responds to expectations of future events, not just the events themselves. This is exactly what the smart money is doing. Large institutional investors, hedge funds, and central banks aren't just reading news articles. They are tracking the hard data in real time. They're watching the 10-year Treasury yields. They're monitoring real yields through Treasury inflation-protected securities, or TIPS, and they're keeping a close eye on the US dollar index, the DXY. They're analyzing where massive flows of capital are going. Gold becomes a primary target for them when a few conditions align. Real yields start declining, the dollar shows signs of weakening, and market liquidity begins to expand. When those powerful forces converge, gold doesn't wait for a permission slip from the news. It moves. So, the next time you see the price of gold making a big move, don't just ask yourself, what did the latest inflation report say? Instead, ask the smarter questions. What are real interest rates doing? What is the dollar doing? And most importantly, what is the market expecting to happen next? That's how you start to think ahead of the headlines and understand the true drivers of the market. You want more simple, no-hype breakdowns of gold, the Fed, and the biggest trends in macroeconomics? Make sure you subscribe to Smart Money Tips Official and turn on notifications. I post weekly insights just like this to help you understand what's really moving the markets. And let me know in the comments below, do you think real rates are headed lower this year? Thanks for watching.